The National Stock Exchange of India has been actively involved with initiatives to educate the young generation of our country on the importance of financial management. One such initiative is NSE FinWiz that focuses on educating and advising the young workforce of the country on wealth management to enhance financial literacy and to empower them.
Insurance is for protection and investment is for growth.
Another program facilitated by NSE IPFT is NSE Financial Quest. This inter-school financial quiz contest goes an extra mile by educating the young students on fundamentals of finance.
On the buzzer, what is this? It's the formula for the simple interest.
Simple interest is the right answer.
Under the NSE Financial Quest Base Camps banner, the program engages students around the year through workshops on various topics, projects, interactive videos and quizzes.
DiCaprio's bouncing checks of Pan Am.
Plus 75 on that. Plus 75.
To facilitate these two programs, NSE along with CNBC TV18 has travelled across the country to bridge the wide knowledge gap in terms of finance. In this episode of NSE FinWiz, we are all set to achieve our objectives once again by gauging young professionals in a new city.
Hello and welcome to Season 4 of NSE FinWiz powered by CNBC TV18 and I'm your host Nithya Balakrishnan. Today my team and I are in the busy and bustling city of Mumbai in the corporate offices of India's largest cement company. A company that symbolizes strength, Ambuja Cements. Ambuja Cements, formerly known as Gujarat Ambuja Cements Limited, is one of India's biggest cement producing companies. Headquartered in Mumbai, the strength of the company lies in its people power. What makes Ambuja Cements different is the company's belief in the spirit of two words, I can, thereby encouraging its employees to take challenges and achieve them to their best. NSE FinWiz visited the corporate office of Ambuja Cements in Mumbai along with experts to gauge how the employees plan to accomplish their financial goals with the theme Dreams Come True.
So looking to my career at what age I am, since I have my children also who are growing up, so I would be requiring money for their education as well as in short-term period. So that is very, very important to know, like what I would be requiring 5 years down the line or maybe 10 years down the line. So
for the medium term, definitely my daughter who is going to grow up and for her entire education and things like that, I want to save. That is one medium term which I look at. And then for the long term, definitely the retirement planning. I want to see places all around the world. I want to be self-sufficient when I am old, and that is on my mind.
Today we have two very special guests on the show. Hemant Rustagi, the CEO of Vice Invest Advisors, and Pankaj Matwal, Certified Financial Planner and Managing Director at Optima Money Managers Private Limited. Thank you so much, Hemant and Pankaj, for joining us on the show. We have a whole host of employees at Ambuja Cements eagerly waiting to pick your brains about financial planning and wealth creation. So without further ado, we're talking about a generation that's hungry to make money, at the same time hungry to live life to the fullest. We are talking about you only live once being something that every Indian has internalized. Given that, how important is it to start financial planning at an early age? Is any age the ideal age really? And how do you go about something as important as financial planning?
So it is very important because if you are investing without planning, you never know whether you are on the right track or no. So planning comes before investment, and as far as age is concerned, whenever you start earning, even without completing your formal education, if you have pocket money which you feel that you can save even for your contingency, then also planning is required.
Well, interestingly, the theme of this season is Dreams Come True. And before I pose a question to you, Hemant, let me quickly ask the audience by a show of hands, how many of us actually plan our finances every month and set aside X% of our salary towards savings? What is the kind of exposure we have to direct investment into the equity markets? Investment into mutual funds? Hemant, a quick understanding really, is this something that you see this trend when you talk to various other youngsters about investing, is this the trend that you see? And when you talk about planning and planning in terms of short-term, medium-term and long-term goals, is that something that Indians do as a force of habit, or is it just, X amount towards savings and then go from there?
Well, I won't say that Indians do it as a habit. I think, but this is definitely a trend which has been growing. What we have definitely seen in the last few years, that people are realizing that they need to plan their investment. If you do not plan your investment, start investing, okay, it's like traveling without an itinerary. You don't know where you want to go. What it does for you is, you clearly know what are my goals. The second is brings in some sense of discipline. One of the reasons why what we're seeing in India, investors have not gone beyond fixed deposit, bonds and debenture, is because they never had a clear goal, clear discipline in the investment approach. When you talk about financial planning, the moment you link all your investment to your goals, you commit something. That, okay, I'm going to invest every month so much money for this goal, and next goal, and the fourth goal.
Absolutely.
50% of your investment success comes because you make a commitment of investing. So the financial planning, what it does, it gives direction to your money. It makes you commit to invest certain amount for a certain period. And this is what I think is the mantra for anyone who wants to build wealth or create reasonably big enough corpus to achieve any of their goals.
Pankaj, Hemant mentioned that when it comes to investing, you're stuck in traditional options of maybe FDs, maximum debentures. You're looking at, your PPF being part of your salary structure. But if you were to look at new vehicles of parking your funds, or top 3-4 vehicles to park your funds, what would, according to you, they be? And when you also talk about the kind of exposure that one should have to each of this, for example, equity markets, real estate, gold, etc.?
See, first thing, mainly there are 4 asset classes like equity, debt, real estate and commodity. So you should have exposure in all of these asset classes, but based on your goals again, based on the time horizon, objective of investment. When it comes to other asset allocation, mutual fund is the best vehicle which allows you to invest, to allocate your money in different asset classes which fits into your need.
Mr. Sawant's dream is to own a house here in Mumbai, where the property rates, real estate rates, it's not a secret at all. About 2 crores is the corpus he wants to accumulate, and on a monthly basis can save about 25,000 rupees.
Okay, you have a time horizon of, let's say, around 8 years. So if you're investing every month, your average investment period is going to be around 4 years. Because your first investment will have 8 years, the last one will have just 1 month. So clearly you need to keep this in mind. 4 years is not a time horizon where I can tell you to build a portfolio which is very, very risky. For example, 100% into equities, out. You have to look at hybrid funds. Now there are hybrid funds of mutual funds, okay, which have varied kind of asset classes over there. There are some funds which invest in equity, arbitrage and debt, and there are some which invest in equity and arbitrage. The reason why I'm saying look at a hybrid fund is because while the aim is to build a reasonably big corpus, it is equally important to keep an eye on the objective, which is to buy a house, and you can't be taking too much of a risk. Okay, so clearly it's very evident that you will not be able to build a corpus of 2 crore with the kind of saving that you're doing right now. There is going to be a gap, so you will have to necessarily consider taking a housing loan. Now, when you do that, my advice always is not to look at one individual goal. That's where the holistic financial planning comes into the play.
Sure.
If I keep an eye on one goal, while you're trying to achieve that, on the way there are different goals. It may be children's education, it may be their marriage or some other goals. We may find some time to go out for vacation.
Correct.
Now, we need to keep an eye on that. So, the mistake that we make is when we look at only one goal is we sometimes overcommit. So, it should not happen that we are ignoring other goals. I'm going back to what I said earlier. Housing is definitely an important goal, but it should not be done at the cost of other goals.
Okay, before we step into a quick break, Kamakshi Lodha, who's a company secretary at the Secretariat Department here, wants to accumulate about 5 to 10 crores and on a monthly basis can save up to 5,000 rupees. But the interesting thing is the time horizon given by Kamakshi is about 40 to 50 years. So I would like you to address this particular query, Hemant, and also talk to us about new age technology-linked investment option for something like this, and not just when you talk about the traditional forms of investment.
Since you have a long-term horizon, invest in well-diversified equity funds. As I mentioned to you earlier, equity as an asset class is risky. You don't have to necessarily make your portfolio risky by going into some very aggressive sectoral fund and thematic fund okay, or the flavor of the month kind of fund, where you see they are doing fantastically well when the markets are doing well.
True.
Go for a well-diversified equity fund. The advantage is that even if you're putting 5,000 or 10,000 rupees a month, your money goes into different sectors, different companies. The money is managed by a professional fund manager who's backed by a strong research team. He's aware of what is happening in India, abroad, how those events are going to impact your performance. So trust a good fund manager, or maybe a couple of good fund managers. Have exposure to all the segments of the market. But the bias has to be towards large cap companies, which are larger companies, and maybe some rule could be 60% goes into large cap, 40% goes into mid cap and small. Build a portfolio like that, and also make one more commitment to yourself that as you go along, as your salary increases, you need to commit more money.
More money.
Don't start with 5,000 and end with 5,000. If you follow these rules, there is no reason why you cannot achieve the corpus that you want to achieve.
Thank you, Hemant. And on that note, it's time to slip into a quick breather right here on NSE FinViz. But stay tuned, a whole host of tips on how to secure your financial security in the senior years on the other side of this short break. Welcome back. You've tuned into Season 4 of NSE FinViz, and I'm in conversation with Hemant Rustagi and Pankaj Matpal here in the corporate office of Ambuja Cements in Mumbai. This segment, we're going to throw the spotlight on retirement planning. When to start, what to look out for when you talk about saving for the senior years. And of course, my first question to you, Hemant, if I can ask you, is there any right age to start planning for a retirement fund? And when you start off, are you looking at 10% of your salary, 15% of your salary? How much of a quantum is a good enough start?
Well, you know, retirement planning, when we talk about, is one of the most important goals for any investor, for anyone in life. But I think, unfortunately, it's also one of the goals which is generally ignored by people. For a simple reason that they can't make a sense of what they need to do for a retirement, which may be 35, 40 years away, or maybe 30 years away, depending on at what stage you start working. But the fact is that, you know, when you talk about a long-term goal like retirement planning, the key factor is to start investing as early as possible. So it's never too early to actually start investing for retirement. But the thing is that not many people can actually work out how much money they will need. Rightly so. I mean, I don't think it's possible for anyone at the start of the career to know how much I will need. But the key factor is, rather than focusing too much on how much I need, the focus should be on starting that process. I think the important thing is to create a separate portfolio for each of your investment goals. Do not make a pool, and definitely do not make a pool where retirement planning is a part
of that. In fact, Sanjay, who's the joint president in the finance department here, actually throws some light on the very same thing that you mentioned.
Normally, we are a salaried class people, and we can make 8 to 9% return by investing our money in dates and maybe tax-free bonds, etc. How do we accumulate wealth by, let's say, making fast money, and we will be happy by making a return which is greater than 12% and tax efficient. So how do you suggest?
Historically, equity has always delivered better return compared to any other asset class. So equity has potential to deliver the kind of returns you are expecting. But more than the fastest, I'll say that in long term. So if your time horizon is longer, then definitely you invest in equity directly or through equity mutual fund. But equity has potential to deliver higher returns, and 12-13%, what you are expecting is not a really big deal if your time horizon is longer.
So the word coming in from our experts here is plan for your retirement fund over and above the savings that you set aside as investment every month, and that go ahead with a corpus in mind and work backwards when you talk about which schemes to pick when you plan for your retirement saving. A whole host of personal finance queries on the other side, but right now, a short break right here on NSE FinViz. Stay tuned. Welcome back. It's Personal Finance 101 with Hemant Rustagi and Pankaj Matpal here at Ambuja Cements corporate office in Bombay. Let's quickly throw open the questions to the audience.
What are the selection parameters to select the correct mutual fund? Is there an expense ratio, inception date? What are the actual return from that mutual fund?
Pankaj, if you can have you answer the question.
See, when you want to compare mutual funds, first you have to see you are comparing with the right category. There are different categories of mutual fund like equity, debt, gold, hybrid. Within equity also you have different benchmarks. Every scheme should be compared with this benchmark. For example, Nifty 50 is a benchmark. So if a scheme is following Nifty 50, you have to see that a scheme has been able to deliver higher return than its benchmark consistently. That is important, because if suppose markets are not performing, markets have delivered 4% return in last 1 year, for example, and your scheme has given 8% return, it should be considered good. But if market has delivered 20% in last 1 year and your scheme has given 15%, that is not good. But sometimes what happens, in the absence of this understanding, people feel that 15% return I got in last 1 year in this scheme, it is good enough, because you start comparing with your fixed deposit. So when you compare mutual fund return, it should be compared with this benchmark.
I have one question, that from the start of the program we are just talking about the equity, mutual fund, etc. What you are thinking about the investment in real estate? Because most of the people here in the Mumbai, and Mumbai the real estate is the best choice for the investment, and last couple of years we are seeing that Mumbai real estate gives a higher returns with the equity or other saving schemes.
I agree with you that, when we look at real estate, we buy something and hold it for 20 years, 15 years, we don't sell it. And when we look at money that we have made, let's say we bought something for 15 lakh and we sold it for 50, 60 lakhs, we said, wow, we made actually great return. We never look at annualized return. Okay? You need to look at annualized return. The second is also look at what are you losing in the bargain. You are compromising on liquidity. Imagine if you as an investor have certain goals for your children education, marriage, taking family out, or other goals, and you have committed yourself that you're investing a significant part of your money in this house. You require money after 7 years. Okay, the house is worth 50 lakh. You require only 10 lakh rupees. What do? You can't sell a room and take that 10 lakh and keep the rest of it. You will compromise on liquidity. Okay. Third is, there are also times where you will not be able to sell this real estate. Okay, you may buy real estate into an area which you think today is a happening area, and tomorrow you have another area which has come up, and everybody is focusing on that, and there is no demand for the house that you have built for yourself. I think there are far too many risks of investing in real estate. And the thing is that because you look at absolute return or absolute amount, not even return, absolute amount that you have built, you get a sense of that you have made a lot of money. I tell you something, I'm not saying that you should go by and base your investment decision on this. There are mutual funds which started 18, 19 years ago.
Correct.
Okay, I won't name the fund. Started at 10 rupees. Today the NAV is cost 400. Okay, now please compare XIRR of this and with the real estate. So when you talk about financial assets, there are many benefits. One, it gives you the potential of getting higher return. It gives you the flexibility of taking the money out when you want it, increase it, reduce it. Okay, so look at how much money have you made on an annualized basis. Never go by the actual final value that you're getting. The moment you do that, you will realize that even though you feel that you made a lot of money, the return may not be that great.
So apples to oranges in this
case. Absolutely. Thank you.
Fair enough. And with that, we're absolutely timed out on this episode of NSE FinWiz. Hemant and Pankaj, thank you so much for speaking to us, throwing the spotlight really on effective retirement planning, and of course, a personal finance 101 with everybody here at Ambuja Cement. Thanks so much for being part of the show. A huge round of applause, please, for our guests.
I was more of a debt kind of person, so I would use less risk-free. I have sufficient career ahead of my life, so definitely looking at to equity and some instruments through mutual fund route or through direct monitoring. I am seriously looking at it, and also on the part of that retirement fund. So whatever portfolio I have built as of now, I will definitely have a re-look at it and with more aggressive approach.
Overall, I will rate the program to be really informative, and there were sections where people were aware of but did not have much knowledge, and this session has given them a much knowledge and a light into many other portfolios that they could think, plan and invest.
This week's contest question is, if you are invested in an equity fund for more than a year, you'll be exempted from. The options are long-term capital gains tax, short-term capital gains tax, or none of the above. Please send in your answers to fwq@network18online.com.
Focus, ideate, innovate, enable.